Well, hello and welcome. Please do say hello in the chat box, pop your name in, and do mention where you are dialing in from. And welcome to you all, and thank you for joining us for our latest workshop, with today's all about demystifying the world of money. And we're joined by Sarah Lavers from My Financial Voice. Now, for those of you who are not familiar with Really Helpful Club, I thought it would be helpful to give you some background as to who we are and what our community is all about. And my name is Sarah Austin, and I'm the founder of the Really Helpful Club. And our team each come from professional corporate backgrounds. I was a senior fund manager in the city, and Caroline Edwards, our events director, was a leading barrister. And Rowan and Francesca, who run Really Helpful Club in Surrey, Sussex and Hampshire, both had successful careers in PR. We've each taken career breaks, and we're now on our journey building this vibrant and fast-growing community together. Now, when I launched Really Helpful Club, I wanted to create a community of positive people, a place to share advice and to connect with others. And now, 7 years on, we've grown into a unique network of like-minded people, a vibrant and collaborative community of well over 15,000 people. And we support each other in our personal and our business lives, and we can help you in whatever stage of life you are in. And we deliver trusted resources, a directory of recommended experts, a jobs board of exciting opportunities and valuable connections and life-changing opportunities to a huge network. Our community is made up mainly of women in their 30s to 60s, facing real life's challenges and transitions. We are a supportive network that listens, and we are here to help and empower you through key stages of transition, from the early years parenting and most career breaks, to the emotional needs of teenagers returning to work, health challenges of a midlife, juggling demands of supporting elderly parents. And it is our shared journeys that bind our community and is our greatest asset. And our vision is to be a supportive community that delivers trusted resources, valuable connections as we navigate our way through life. And we'd like to invite you to join our community if you haven't already done so. It's free to be a member, and it will give you access to our events, our resources, and a weekly newsletter with all the latest information and updates. Now, we'll put a registration link into the chat, and we look forward to welcoming you to our vibrant and fast-growing community. Now, we have an exciting program of talks and workshops coming up in the next few months. So please make sure you visit the website regularly, look out for our newsletters, and be sure to contact Caroline Edwards about our events program. Now, all our webinars and online events are recorded, so please do take a look at the talks that we've already held. And if there's something that you'd like to get a recording for, please be sure to contact Caroline and find out how you can access that. And also, if you see an event that you would like to book into, please visit the website and book your place via the booking link. Now, today's workshop is the latest in our personal development program, and I'm delighted to introduce you to our speaker, Sarah Lavers, who will give you the essential skills to break down common financial myths about the world of finance and some practical tips on how to start engaging with money. Sarah is the founder of My Financial Voice, and My Financial Voice offers short financial education courses to give you the life skills, the knowledge and the confidence to navigate the world of finance and investing. Sarah brings 25 years experience as an international investor. Now, I'd like to emphasize that this talk is for educational purposes only and no financial advice is given. And just before I hand over to Sarah, a little bit of housekeeping and guidance about the format and timings. The session will last just over an hour. We'll finish about 12. And it's an interactive workshop. So please pop any questions you have into the chat box. Caroline will collate these as we go along, and we'll find punctuation marks in Sarah's talk to be able to ask those questions. We'll also run a Q&A session at the end of the talk. So if there's anything that you would like to raise, please, again, pop those into the chat box. What we would ask you is to make sure that you're muted during the talk so that any background noise doesn't get picked up in the recording. Now, you don't need to take notes, you don't need to take screenshots, because we're taking a recording of this and we'll send this to you afterwards, together with Sarah's contact details. So we hope you enjoy the talk, and with that, I will stop sharing my screen and hand over to Sarah. Sarah, thank you very much.
Thank you very much. Thank you both and the Really Helpful Club for inviting me today, and wonderful to have everyone here as part of the group. I will take questions as we go along. I think that's a much better way of doing it interactive. What I'm going to try and do now is share my screen, but it is host disabled participant screen sharing, so might need one more approval. It's not letting me share the screen.
I've just made you a co-host.
Got it. Sorry, yeah, I've got it. Fantastic. Great. Here we go. Can everyone see this?
Yes, thank you.
Brilliant. So if you bear with me for the first 10 minutes, we're just going to get through some material, and then we can start, I hope, being a bit more interactive in terms of what questions you may have and where we're going with this. So what I'm going to start with is investing. Why invest? And the short answer is, at the moment, or for the last 10 years, in your bank account, you've only been able to get less than 1% return. And we all know inflation is above that. And certainly at the moment, inflation is 5%. And what that could mean is your £100 in your bank account at the end of the year is only worth, in buying power, £95, because inflation has eroded the value of the £100 in its capacity to buy goods. And so to generate what's known as a real return, and that means above inflation, we look at various instruments that we can invest in. And the ABC is bonds, equities, and then some alternatives, which we'll look at as well. But the main building blocks are bonds, and the word for bond is a fixed interest debt instrument. So it's an IOU from someone else, usually the government or big corporation. You lend them £1,000, they give you some interest and they invest in it, and over time they pay you back at an agreed date. And then the other main area of investment is equities, otherwise known as shares or stocks. And we use those terms interchangeably. The Americans tend to talk quite often of stocks. And then you can also invest in shorter term government notes, which are known as bills. In the US, we've got gilts here. And then you've got other assets such as gold, and they haven't marked them here, but commodities, private equity, which we'll touch upon, and even cryptocurrency, which are all known as alternative assets. They're usually a much smaller percentage of anyone's portfolio, because some of them are higher risk. So those are your building blocks, and we're going to start with the first two main areas, which are bonds and equities. So another chart, so this one here, so I forgot to go back to that one. This one here shows you that over time, and we're going back to 1800, because history actually gives us a good idea of what's happening in the world. Over history, this is the US stock market. The US stock market is given a 6.7% real return over time, every single year. Now, I have to be very clear. It doesn't mean it does it 2009, 2008, 2010. It means over a period of time. And sometimes it can take 10 years. You have to be invested for 10 years to actually get that average return over that time period. So we need to be very clear about the fact that we are looking at over a longer period of time to generate that return. But that is far better, obviously, than a cash deposit. But yes, there's risk, because in between things go up and down. And that has a grand word of volatility, and otherwise known as risk in the jargon. And we're going to explore exactly what we mean by that in a minute. But let's look at those returns over time. Slightly more globally, this is a research done by Credit Suisse, which they've kindly allowed me to share with you. You can see here, if you look at the different years, you will see that the returns are, for the US stock market since 1900, 6.6% again. So we're getting these similar numbers. They may vary by a few digits. And the UK is at around 5%, so it's a slightly lower return. We can see that also the UK is doing quite well at the moment as a stock market, but partly it's because it's viewed as a more of a value play, another term that we use. And value means companies that are not perhaps as expensive, not growing as rapidly. We have a lot of banks, oil companies, mining companies as well, which are not the new technologies. So that's why the last 10, 15 years, we've seen the US stock market certainly do better because of the technology and growth component. That may be changing right now, but it's just, we're introducing this concept of factors that impact the stock market as well. You'll see that bonds have a slightly lower return, but they are much safer. They don't tend to, particularly if you're invested in what are known as investment grade, and there's an acronym called IG, and these bonds are rated. They have AAA rating, which means blue chip, which means high quality and very unlikely to go bankrupt. That's of a country and a company. And these are called sovereign bond ratings. Sovereign is the word used for a country issuing a bond, because it is a sovereign state. Doesn't mean they have kings and queens necessarily. And in the UK, they're called gilts. And in the US, they're called treasuries. And those are the core building blocks of the reference points of the fixed income market. So they always form part of a portfolio because they don't tend to go up and down as much. But the returns from the stock market over time have been better. And why does this matter? Well, it matters if you're investing for the long term. And we look at the magic of compound. And here you'll see that if you generate if you get 3.5% real, which is roughly what some bonds have given you, then you get a good return, but it takes you 20 years to double your money. Now, double your money is nice, and sometimes it's not worth taking that risk. But in the stock market, if you take an average of 6.6% returns, so let's round it up to 7, then you can double your money, given certain timeframes, over 10 years. And that is where compound comes in. And there's a rule of thumb, to double your money at 7%, it takes 10 years. I want to take another example, which is perhaps more relevant for a question that was brought up a bit earlier, was if you have grandparents or godparents who are happy to contribute to a junior ISA, here's a sort of idea of where you can start getting compound returns, because you've got a 20-year period with which to invest and go through some of the stock market negative cycles, because stock markets do go down as well as up. So for instance, you started with 1,500 and £600 went in every year. Then if you generated a 6% equity return and reinvested the dividends, say, you could look at possibly that capital invested over time paying for university fees by the time the grandchild is in their early 20s. Now, this is a best case scenario in some cases, but actually over time, that's not been too far off what the stock market has achieved. So what we look at is the rule of 72. For those of you that like maths, it's just an easy, because compound interest you actually have to calculate manually in a spreadsheet. It can be a bit cumbersome. I've done it longhand here. So you see £100 times 1.072, and you multiply that, you compound the gain you've made each year. So you keep the interest in there, and you'll see it takes exactly 10 years to double your money. So there's a little shorthand exercise, which is quite useful when you're looking at returns. You take the return that you've been promised. Say your financial advisor says, right, I think I can give you about a 5% return. So you take 72. If you can do it on an iPhone, that's much easier. You take 72 and you divide that. If anyone's got a calculator, you take 72, divide that by 5, and hey presto, it'll take you 14 years at that return to double your money. It's just to get a handle on compound returns. Now, we're going to now step away from having seen we've got two categories we can invest in, bonds and equities. I've been pushing equities because a lot of people view them as much riskier, and they are. So we are going to look at that and caveat how you can minimize some of the risk element. But let's focus at bonds, where you're going to get a more guaranteed return with less risk of losing money over the shorter time period. So bonds have existed for a long time. You can go back to Venice. Some of the first traded bonds were in the 12th century. The Doge of Venice needed to raise some money to keep away the Ottoman Empire that was impacting his trade. So he raised some money off his citizens. It was called a prestanza. It generated a 7% return a year, and it could be sold to your neighbor. That was a tradable bond, an IOU, a fixed income. It generated 7% a year. And fast forward right through to the creation of the Bank of England in 1694, where and since then the Bank of England has issued gilts, sovereign debt, and has never defaulted. So it is one of those bonds that has what we call a AA rating. There are a few countries with AAA rating like Switzerland, Norway, and a few others. So the quality of the government issuing the bond is important. The quality of the company issuing a bond, Barclays, Glaxo, all these companies issue bonds as well that you can invest in. And their interest rate really is linked to where the base rate is in a country, and also therefore the base rate is also which is set by the Bank of England here and by the Federal Reserve in the US, and that obviously is linked to inflation. So where we started our conversation, we come back to what we're seeing right now. Inflation is 5%. Does that mean interest rates are going to go up to 5%? Well, who knows? So Mystic Meg probably has the answer better than I do, but the short answer is we know that interest rates are going up. We've been told they're going to go up, but the central bankers have also been at great pains to tell us that some of this was what they call an external supply shock, i.e. the oil price may come down over time again, and some of the bottlenecks that we've had that put up producer prices again are called transitory. How transitory? That nobody knows, but certainly if they are an 18-month phenomena, then I don't think we'll see interest rates going up to 5 or 6%. The thought is that interest rates will come down to around, inflation will come down to around 2% again in the future. And why could it come down to that? Well, historically, inflation has been around 2% throughout history. And I'm going to show you that here. So these are the centennial. This is from the Bank of England, some research they did. It's the chart on your left. So the nominal interest rates in the 1300s, money was difficult to get, was 7%. Inflation was around 2, so you got a real return of 5, which was pretty good. And if you look at the last century, nominal rates were around 5% in the 1900s, and real returns were around 2%, similar to inflation in that period, a little bit lower. Inflation averaged 3%, with some very big spikes in the 70s. So you do look at the longer term. In the 20s, since the 2000s rather, we've had very low inflation, but it is now picking up. So what the banks are trying to achieve is a real return of around, for banks to make a real return of around 2%. We shall see where they go. Certainly, the last 20, 30 years, interest rates have gone basically one way, which is down. That is now changing, and that is changing the whole way that we look at investments. And it does make it an uncomfortable transition from a trend for the last 30 years of declining interest rates and more benign market conditions, stock market conditions in this instance. However, there's always opportunity when there's change, because you get mispricing, and that is what the industry looks for. It looks for opportunities to invest where not everyone's already worked out that there are some deals to be had. So just to finish off on sovereign debt, I can take this more in the questions, but debt, the government issues debt. The combination of the financial crisis followed by COVID meant that you can see that most governments have issued debt back up to 100% of GDP. That's an important number. It's getting quite granular here, but if debt in the EU used to have to be only government debt, only around 60, 70% of GDP, We've long lost that after the 2008 crisis and also with COVID. So we've been issuing, or governments have been issuing more debt, but at around 100%, we start seeing that it starts reaching a level where people can get a bit worried. And in fact, as investors, you may demand a slightly better return because you're going, a little bit too much debt in the system. And that's another reason we may see interest rates going up in the US to attract buyers of this debt. And the mechanism that was used to issue a lot of debt was quantitative easing. That is a real technical term. It's shorthand, really talking about the creating some debt that was the central bank buying debt from commercial banks and bringing it onto their balance sheets so that the money that the central bank gave the banks could then go out and be spent in the economy. That's in simple terms. It's still a financial experiment. It's still relatively new. It's only about 12 years old. Nobody quite knows what the legacy of this is. There was a thought it was going to be inflationary because it is putting money into the system, into the monetary system. So there was more money sloshing around. And it is also, it has pushed people into doing things with their money because they can't get anything much interest on their bank account. So it has had an impact, but in fact, for 10, 12 years, it did not prove inflationary, but it is now. So this is called money supply and how it is linked to inflation. So textbooks will be written about this. We're living it. Nobody knows the answer, but we are seeing some changes. So just to finish off on that, here are some main rating agencies. When you open your FT, you'll see Moody's, S&P, and Fitch. Standard & Poor's is S&P, that is the main US index, but they are also a rating agency. And you'll see AAA, AA, and it goes right down to I think down to what are known as junk bonds. But anything below BBB goes into what we call high yield or junk bond. So more risk of this investment not doing well. And on the course we look at, for instance, we look at Barclays, the rating of a Barclays bond, what rating it has, etc. So you can start to look at the quality of the corporate bonds that you're buying as well as the sovereign country bonds that you buy. Now, how much debt is there in the world? This is quite a useful reference point. You'll find that there's government debt, there's corporate debt, and there's personal debt as well. And roughly put the three together and you are at around 300% of GDP. That means people and the whole countries and companies and individuals have borrowed 3 times their annual income. And it's not, in fact, this number makes sense because if you think of what you can borrow as you're starting off in your career as a mortgage, you can usually borrow 3 times your joint salary. So, but at that point, you start maxing out. And it's really, that's what happened in the financial system, where we started being a little bit more creative in how we created money because the standard measures of raising money had probably been exhausted. So where do we go from here? Well, it'll be interesting to see. And this is why the stock market is also looking, and the bond market is looking at the impact of rising interest rates, because we have to allow for inflation and the fact you've got to attract buyers to these bonds. Most of you will be probably familiar with the concept of GDP. I'm just going to illustrate that here for those of you not. GDP is gross domestic product. And that is what each country generates every year. Really, a simple way of looking at it, but a very accurate way of looking at it, is to go, how much does every single person generate and what do we spend it on? And if we take the average income in the UK and we multiply that by the number of people that live in the UK, you get to the GDP. And it is worth doing that. If you have a calculator, another little trick with your, if you have an iPhone, if you turn it sideways, you can get all the noughts on there. So I'd encourage you to put in 67 million into your iPhone and then multiply that times, say, 30-odd thousand pounds of average income, and you'll notice a whole rank of noughts, and you'll notice your decimal points, 12 decimal points, essentially trillion, easy one to remember. And 2 trillion is what the UK every year generates. And most of us, what we earn, we spend. We save a little bit, but we spend a lot of it on mortgages, on haircuts, on cars, on services, etc. So that really is a reference point. And I use that as an example. So when you see a headline, Apple, the stock Apple, the share Apple, has a market cap of $2 or $3 trillion it nearly reached the other day, you start to see how big that is. And it gives you an idea that this company has got political power as well, lobbying power, as well as selling iPhones, to give an example. So you start to see where stock markets and big companies play into how the world functions. So reference GDP is just to be aware that we often use it. For those of you who are less numerate, here are the zeros. And just a nice way of looking at the size of the world is the US is the big economy, which is why we can't ignore it from an investment perspective. And you'll see the US is $20 trillion. Another easy number to remember, $20 trillion. So if Biden, which he said a year ago, we're putting $2 trillion into the US economy, you start to see 10%. If you got a 10% pay rise tomorrow, you go, I could spend some of that. So it gives you an idea of billions and trillions and what these actually mean. So where I'm going with that is to give you an idea of asset allocation. So when you're investing in the world, this is a different way of looking at it rather than I've given you a chart format here. You start to see where the big investment blocks are for investing in terms of countries. We do need to look at the regulatory environment. So the legal environment in China is very different. So you may find that you don't want to put 15% of your money in China, but it just gives you an idea of where the building blocks are. So I'm going to pause here because we've now covered the basics of the building blocks, and we're going to go into how we can look at the stock market next, if there are any questions.
No questions so far. If anyone has a burning question, do just unmute yourself and ask it now, please. No, you've obviously explained it beautifully. Thank you. We can carry on.
Probably a barrage of concepts. And so this was the technical explanation of GDP. It is household final consumption. So what you and I spend, all of us, plus a bit of government expenditure, which is typically around 10%, and then what companies invest in, which is around 10% as well. But that was just to tidy up on that concept. So we now come back to what can you invest in? So we know you can invest in government, sovereign bonds. We know you can invest in high grade bonds, IG bonds, with AAA rating down to BBB rating. Below that, they're known as high yield or junk bonds colloquially. It doesn't mean that they're not a good investment, some of them, but you need a good bond fund manager to do the work for you, because you can generate in some emerging markets 5-6% return today, even in a low interest rate environment. And they do the research for you to check that the risk of the bond. And so it is definitely worth looking at, but being aware that there is more risk involved in terms of some companies will not do as well as others. Then we got shares. And you'll see there's a little chart on your right that says the returns you can get. So you can see you do get higher returns from investing in shares over the longer term, but there's something called risk. And again, what's meant by that is the stock market goes up and down. Now, invested in one share, and say you'd invested in GE, General Electric in the US, that share's done nothing but fall over the last 10 years. So you wouldn't have done very well. Had you invested in Apple, you would have done extremely well. But this is putting all your eggs in one basket, and it's not what we recommend. So a good way of looking at investments is spreading risk. And what we're going to look at are some ways of investing in different types of funds that give you that diversification. And the reason you do it is what we alluded to at the beginning. It's a same chart, but slightly different presentation. This shows you the different returns from 1900 to date per country, equities and bonds. And again, you'll see the UK is around 4.5–5%, and the US again at 6–7%. those real returns. So if you add inflation, 2% on top, the actual number you may see is around an 8% return a year. So you go, well, why wouldn't I do that? Why would I even bother with bonds? Here's the rub. The rub is about to come. This is risk, this is volatility. And yes, indeed, the chart on your left is pretty scary. Up, down, 30, 40% every few years. Now, if you needed your money at that point, you invested in the stock market and it fell 30%, as it did in March 2020, and you were buying a house, that could hurt, which is why we talk about time in the market. I cannot emphasize that point enough. So I want to emphasize the good news is you can get your 6% over time, but the bad news is it is over time. So, and a lot of people don't invest for that reason. Now, and I think that's a shame as well. So you need to be quite clear what you need your money for. If it's a pension fund and you're still young, don't worry about it. Put it in there. I would say it's worth taking that risk. But if you are a little bit older or you need the money for different reasons, you need to look at which pots you're putting your money into. And you'll see on the chart on your right, clearly shows you with bonds over a 10-year period, you very rarely lose much money. Now, this year you have lost a bit of money at the start of the year because interest rates have gone up. And I won't spend too much time on bonds, it's just a small technicality. Bonds, you have to look at the price and the duration, the maturity of the bond. Now, at the beginning, a price is always issued at what is known as par, which is 100, and you are repaid at par, which is 100. But in between, the price can go up and down depending where the interest rates go up and down. And in short, if I had bought a bond issued, say, a year ago, giving me a 3% interest return, it was issued at 100. Today, it's probably worth 95 because actually I could probably buy a bond issued at 4% today because interest rates have gone up. So the value of my bond has gone down. But if I wait till it's due to be paid back to me, say in 10 years' time, I will get it back at 100. But in between, the price can go up and down, but nowhere near as much as shares. So what does this actually look like? Well, I had some numbers. There's some research that's been done. The stock market falls about 10% every year. It falls about 15% every 2 years. And every 9 years, it'll fall 30 to 35%. That's called volatility. And if it hits you at that moment, it can be very painful. And you can see it here. So this is the last main acronym for the day. It's the Morgan Stanley Composite Index, the MSCI All Country Wide, ACWI as it's known. And it comprises of 3,000 listed companies in the world. There are more listed companies that exist in the world. I think China alone has around 2,000 listed companies. But of course, we don't want to invest necessarily in all of them. They have to be liquid enough. i.e. there has to be enough of the company floated on the stock market for you to be able to trade in and out, and they have to be of a certain size. So Morgan Stanley does all that work for us and says, okay, these are the 3,000 companies that we think are big enough, listed, liquid enough to be considered as global investments. And this is probably, certainly for those that are time poor, a really good way of looking at investment. Also say for a junior ISA. You can buy funds, which are called tracker funds. They are exchange traded funds. They are low cost funds, and they mirror this index. They mirror a global index. And in terms of fees, they can cost as low as 0.2%. And I'm bringing in the fee concept here. A managed and actively managed fund. You may have heard of Terry Smith. He's quite a famous fund manager, the Smith Funds. He's a very good fund manager and he charges for it. So his fees will be over 1% to manage your money, but his returns have been good. So that is a preference. It's something you should talk to your financial advisor about, or think about what fees you're prepared to pay for the returns that you get. But a simple solution is looking at these acronyms are unfortunately bandied all over the place. They're known as passive funds, index benchmark funds, or ETFs. That's the most common. And the big issuer of them is BlackRock, and known as iShares, and Vanguard, often with a V. You'll find them listed in the back of papers, talked about in the press as well. And a lot of people do buy them, and they are a nice, what I call a ready meal. You know, they're pre-cooked, pre-organized for you, and they deliver the same return as the stock market. So you start to see again here what that can feel like. And it doesn't feel like 6% a year, does it, when you look at it, or 7% a year real, which would translate at 8% nominal. It looks minus 42, oh my God, plus 35, plus 13, minus 7. So you start to see that when you're on the stock market, it doesn't feel like a smooth return of 6.6%, because that's not what happens every year. It's over time. And I really cannot emphasize that enough. But that return, nonetheless, is what has historically happened. Doesn't mean it'll happen in the future, but you know, it has happened for 100 years. So let's look at it, not over 100 years, because we've done that before, but let's look at it here. It takes a little while to get your head around these numbers, but you'll see that since 1987, it's here on my chart, the MSCI ACWI has given you 8.5% return. That's nominal, take off 2% for inflation, and hey presto, you again get this 6.7% that we saw on the very first chart that we looked at. In this case, you'll see emerging markets did do quite well, but in the last 10 years, if you look at the last 5 years, their return has not been anywhere near as good. Now, caveat here, and it does make it a little bit harder, going back to this chart, normally it's something like every 10-year chunk, you have 3 down years. And it certainly worked if you looked at 08 to 2018, or 17, that gives you the 10 years there, you'll see 3 down years, 1, 2, 3. If you take it 2021 back to about here, whoops, we're probably due a down year. Now, Mystic Meg is the only one who can tell you when it will happen, but there is probably a little bit more statistical probability that we have a down year soon, because we haven't had a really bad down year for a while. Does that mean don't invest? No, but it just means don't put all the big lump sum in. If you're going to have a great aunt who leaves you a lump sum, perhaps drip feed it, and look at other investment. Look maybe at bonds and other investments, not just equities. However, equities, if you've got a longer time frame, again, as we said, plus 5 years is normally about right. Normally markets will recover. The only 2 decades over the last 100 years where it took longer than that time period was had you invested in 1929, it took you a little bit longer to recover. And again, had you invested just before the tech wreck bubble of 2000, it took you the full 9-10 years, I think, to recover your average return. Now, you're going to be familiar with a lot of the constituents of the top big companies in the world: Apple, Microsoft, 3 trillion at the end of December for Apple, and you start to see how big these companies are, and we can't ignore them. What does it look like sector-wise? Here we go. Again, a couple of little alerts. Typically, when a sector goes above 22%, you'll see technology was at 23.5. Over 20%, historically, that is a higher percentage than any sector normally maintains. So the banks just before 08, where over 20% of the Morgan Stanley Composite Index, again, an indicator that the sector is possibly overvalued. But there are lots of other sectors that are not. And diversification is again the key, but you get a nice spread of investments with this. The other main index is the, if you don't want to use, or sometimes the fund manager doesn't use the Morgan Stanley Composite Index because you have to pay for that. The other one is the FTSE All World Index. I've just given you a screenshot of their fact sheet that you can find online. The link isn't here, but I can send it for those. If you just put it in, it will come up. And again, covers similar number of companies, and you'll see the historical returns. If you can zoom in, it's about 13% return the last 5 years. That's nominal. So again, take off inflation to get the real return. So hopefully that's given you a sense of stock market. I'll just see if there are any questions on the stock market before we start pulling it all together.
There's one question, which is, given the geopolitical risk, supply shocks and rising inflation, please can you explain about gold and the conditions when this is an attractive asset class?
Really good question. So gold, going back to our chart, interestingly, right at the start, gold, certainly historically, up until this one goes to 2011, hadn't given a very good return over time, but it does in terms of shocks. And it's very hard to, this is over the longer term, but you'll see in the 1970s, gold blipped up a lot. Gold gave a very good return because inflation was kicking in and it was viewed as a real asset. So it is viewed as arguably an inflation hedge. It is also used as a safe haven asset. So in 2008, the price of gold doubled. That isn't so visible here, but you can just see a little blip of it going up. But it hasn't done that much in the last few years. But in the last week or so, it's gone up again. Again, with Russia, geopolitical risk, it's viewed as a safe haven, and people have been buying gold. Historically, they bought gold and the Swiss franc, but gold more specifically. And it could be that that's what we will see again if Russia does invade Ukraine. And there's more activity, I think we'll see people buying gold. Bitcoin is possibly viewed as a digital gold asset. That is something that's been put forward as a theory. I'm just going to talk about that now because actually it's quite interesting. There's an interesting article by Niall Ferguson the other day on Bloomberg talking about Bitcoin. Bitcoin came down with the stock market. So a lot of the pundits were told you so. It's a volatile asset. It goes up and down. It's the term they use, it's correlated to the stock market. It had a lot of speculation in it, bit of a bubble, etc. Who knows? Again, we come back to Mystic Meg, we don't know. But what we can see with Bitcoin was we don't exactly know who created it, but the character who's attributed to is Satoshi. He published a white paper in 2008. And he gave the code basically to create Bitcoin because it is a decentralized ledger. It's created through an algorithm, and this algorithm uses what's called blockchain technology. So each Bitcoin that is created has to be recognized by all the other existing Bitcoins that have been created. So the first one has to say yes to the second Bitcoin. Yes, I agree, you exist, and so on and so forth. So it's called like a daisy chain. So blockchain technology, putting it really simply and probably rather badly, but there we go. So this ledger technology enabled Bitcoin, and certainly for years, I haven't got an unfortunate chart here, but it did nothing. And then it exploded probably about 4 or 5 years ago. And as we know, the first Bitcoin was worth a few cents and then a few dollars. And I think famously someone used it to buy a pizza, and the rest is history. It went up to $68,000 and it's back down to around 35, 40 now, and it's trading around there. But Bitcoin is specific in that there are apparently only ever be 21 million Bitcoins issued. So it is, if we look at the definition of money, it does have what is known as a store of value. The other definition is medium of exchange. I think we can query its value as a medium of exchange, although having heard the story of someone buying a cup of coffee with it on the train the other day, that's clearly a medium of exchange. And a unit of account, well, those are the 3 definitions of money. So actually, I think we do need to look at it. And people are trying to crack the code since it was ever launched. And maybe they will one day, but not to date. So a lot of people, I'm sure, have tried. Yes, it is energy intensive because each new blockchain, or each Bitcoin has to be recognized by all the others. And today, that mining Bitcoin, as it's called, uses as much energy as, say, a small country, the Netherlands or Norway. Other technologies which use blockchain, Ethereum being another, are coming up with ways which are less energy intensive, also, we are told. Anyhow, come back to questions on that, but that I just wanted to mention that some people view Bitcoin potentially as digital gold because there'll only ever be so many minted, and gold has its value because actually, unbelievably, there's only ever been 3.3 Olympic pools worth of gold mined and found. So it is a store of value.
Fantastic, thank you. Just a couple of other points. You mentioned hedging. Would you mind just explaining what you mean by that?
Hedging is used in two contexts, but let's look at it as hedging your bets. So you can lay off some risk when you're betting on the horses. You can hedge your bets by using different combinations of placing your bets on different horses. So that's actually what it's all about. So the main areas of hedging are currency risk. So people can hedge against it, can buy. So when you're buying a fund that has dollar and yen and other currencies in it, you can say, well, can I have a sterling fund? And that's called sterling hedged. So banks create these derivatives, which your fund manager puts in, and basically you're guaranteed a certain amount in sterling. It does have a cost. You will pay a little bit extra for that, but that is hedging the currency. Hedge funds are another way of looking at hedge. And really, hedge funds, a bit of a misnomer because there are about so many different flavors of them. But anyhow, the point being is they can go short a share. And that means they can sell a share and say they're long a share like Nestle, and they think, well, Nestle is going to do very well, but I'm actually going to short some Unilever because I think Unilever isn't going to do as well. So they make money if Unilever goes down. Now, you can't just short a share. You've actually got to go and borrow it from someone. I'm going to technical here, but I just want to say that there is a mechanism whereby you can't just sell a share that you don't borrow from someone else. And that is how you can hedge a portfolio, by being long one share and short another. That's what hedge funds do. So hedging is laying off risk.
Thank you. I try and watch Billions with my boys, and I have to say the concept of shorts come up all the time, and I'm completely flummoxed by it. Right, a couple of questions. After deductions for inflation, what is the typical net income, i.e. after tax, over, say, 10 years for a decent fund investment?
So I'm going to go back to this chart here, the Credit Suisse one. Is this one you can see? Those are the annual returns of the equivalent of the Morgan Stanley Composite Index for shares. The global world indices, 6-point-something%. The US, take 5 if you want to include the other markets, plus 2% inflation. So your nominal will be 7 or 8%. And again, we saw that when we looked at the Morgan Stanley returns since 1987. Here we go. So if you buy a tracker fund that mirrors a global index, that is what you should achieve over time. But as we also saw in 2008, the market went down 41%. So I have to reiterate, over time, and minimum 5 years. And if you have a really bad stock market crash, it can take 7 or 8 years to get back up to that number. But let's look at some real examples. So if it's all right, I'll come back to that question when we're going to look at Terry Smith, for instance. And so we can look there at what a fund manager can achieve. And we're going to look at a couple other funds, if that's okay.
Great. So I have one more question, and then I think we probably need to get back on track. A few commentators have raised the possibility of stagflation. Please, can you explain this concept and the conditions in which this occurs?
Yeah, it's a really good question too. Stagflation is most typically associated with the 70s, where we had very high inflation after the oil shock, but we also had low growth. So it's a nasty combination because you've got inflation going up, not much growth in the economy, so wages are behind inflation, cost of living is going up, and people basically really suffer in stagflation. And there are whiffs of it right now. If inflation stays at 5% and our wages only go up 2 or 3, we have and price of oil and energy costs go up, that is stagflation. Let's hope it is not sustained, because it is very uncomfortable and very painful.
Great, thank you. So I've just got a message from somebody who's unwell and can't attend. Right, I think we should get back to your presentation now, Sarah. Thank you very much for answering those questions.
So, right. Does that mean you put everything into equities? And as we said, unless you've got a longer term time horizon, you may not choose to do so. And probably the other most useful tip of today's presentation is looking at your risk appetite. And it is slightly unfortunate. Financial advisors have to ask you what your risk profile is. And most of us will go, you know, not too much risk. Unfortunately, then we are putting ourselves bang into the possible steady or cautious category, which means your returns will be possibly as low as 3 or 4% a year, which might be good in a bad market, but not when you're looking over the longer term. So we need to understand what we mean by risk, and what we mean is your appetite for and your ability to look at something that falls 30% and not panic. And if you have put everything into Bitcoin, it falls 30%, probably do panic, because I don't know, Bitcoin may recover, but it may not. But if you put a good chunk of your money into a well-diversified global ETF tracker fund, if you can take a bit of time, put a bit of time on your side, you probably will recover most of the losses that you encounter, as we saw in March in 2020 to date. So it is about how you manage psychologically with the risk. And it is not easy. I mean, I have been in the markets 30 years. I will tell you, in March 2020, I was very tempted to sell. I thought, this time it's different. The most expensive words in the English language, this time is different. Historically, that has cost you money. So take a breath, take a chill pill. But however, go in with your eyes wide open. You will get resets in the stock market of 30 or 40%. They do happen. So, and if you can't handle that, and it's absolutely fine if you don't, you've got two options. One is to look at slightly more cautious approach, which has a lot of merit. So you'll see the cautious fund is 0 to 40% in equities. The returns are not as good, but you're still getting 4 or 5%. So, and if that is enough, that's good. You know, it's steady income. It's much less volatile. You sleep easier at night. If you're prepared to spice things a bit, then you can see the level of returns you can get here in sterling. 12 months December, it goes from 4 to 13. And then 24 months, you see 8 to 20% return. This is only recently available because when you go and talk to a wealth manager or financial planner, very often they say, well, I can't really give you a benchmark because, you know, your mixture of bonds and equities. And so, you know, 5% is a good return. This is called ARC, private equity, private clients research. The two links are here, suggestus.com. And if you sign up, you can access this information. It used to be really expensive, not available to retail investors. I would encourage anyone who's got a portfolio to access this because it gives you the tools with which to hold your wealth manager to account. I mean, mostly they're doing a good job, but you need to know if your fund is or your wealth manager is performing well for you, depending on the risk level that you have chosen. And then this is very difficult to read, but this is just goes back to 2008. Again, we talked about the stock market falling, and you'll see every year it has fallen at some point. The least I think was 4% one year, but you know, the most was 25 and 21. So stock markets do go up and down, volatility. The other way of looking at things is going, okay, well, you know what, it's not for me. I'd rather have bricks and mortar. Absolutely fine. I've included this chart. You know, if that floats your boat, that's absolutely fine. The stock market isn't for everyone. However, I would just point out two things. You know, it's useful for smaller amounts of money, maybe an ISA or a junior ISA. You know, you can't buy a house for £30,000. I wish, but you can't. So for smaller amounts, it's useful. If people are not comfortable with stock market risk, then investment properties are another way of looking at. That's not what I'm covering today, but I'm just showing you the chart. Actually, the chart has two purposes. Is to show that even had you bought the start of the Thatcher years in '83 in London, right through to the peak in 2018, prime London property only narrowly, probably in Chelsea and Kensington, beat the Morgan Stanley Composite Index over that period. This was a chart that I found, which is interesting. So they're neck and neck. Having said that, again, you know, it's you have to look at your approach to risk and what you're comfortable with, and that's really what we mean by it. If you're going to have sleepless nights, then it's not worth investing. That's something that's going to cause you a lot of grief. That's where we come back to looking at multi-asset funds, where you work out what your risk profile is. So if you're cautious, balanced, steady, or happy with more risk, it's usually ranked 1 to 7. Vanguard uses that rating. Others, and I'm going to go straight onto this chart here, Vanguard multi-asset. So for 20% equity, they call that level 3, right up to level 5. Actually, I probably mean level 6, that's a typo, 100% equity risk. And again, we go back to that rule of 72 at 7% return a year, you can double your money. You can technically double your money every 10 years. Again, not a guarantee, but it is what the stock market has achieved over the 100 years on average every 10 years. So those are the sort of numbers I'm trying to really make you familiar with. It's the stats which help. So when the market does fall, it's easy to panic and sell. As I said, in March, I was really tempted. In fact, I sold a couple of shares and then luckily went, okay, that's enough. It was the buying opportunity. Now, right now, if you have, some people may go, okay, I know I've got a building project in the next 2 years. I want to perhaps take some money out of the market because I know I'm going to need it in 2 years. And if we do have stagflation and a bad market for 2 years, then I know I've taken some money out. So it is working out what you're comfortable with. So active versus passive funds are really the last few concepts we're going to look at this morning. So I talked about tracker funds, index funds, ETF, or passive funds. They're all rather interchangeable. That's the jargon, which is rather hastily used and not consistently. But the interesting point there is they're low cost, typically. They do give you exposure to a wider range of investments. And this is the sad bit for my industry. I was a fund manager for 20 odd years. It's very hard to beat the index. And you could go, well, you're paid to do so, so why don't you? Well, there is something called survivor bias. So only the good companies stay in the top 100 and all the others disappear. So you have to have picked Apple and Amazon and Facebook and Google before they, and stay with them as they go up. And that's not easy to do consistently. Some people do manage it, and they're often in the star fund managers, or their style is correct, but not everyone does. And unfortunately, there are also a lot of fund managers who are not so good, in which case you're better off not paying them 1% fees, but actually investing in a tracker fund. And what this research shows is, it's slightly difficult to read, but what you'll see is over a 1 year period, active fund managers will perhaps beat that will beat the index. About 50% of them will. And that's, let's take a global fund, 50% will beat the index, but over 20 years or 15 years, far less do. So what you find a number of people do is they go, okay, well, I'm going to put X% of my savings or my ISA into passive managed fund, and then I'm going to decide that I quite like the idea of having a bit of more healthcare or specialist fund in renewable energy, or things that interest you and things that you think could do well longer term. And you can buy actively managed funds, more specialist funds, and that's something certainly worth looking at and discussing with your portfolio manager or your wealth manager. Here's an example of the fact sheet, which was what we wanted to look at. How do you work out what they do? So I've taken Terry Smith, apologies for the size, but you can download this on Terry Smith's website, fundsmith.co.uk. I will try and zoom in a little bit to make it slightly more visible. So, okay, so here we go. So you'll start to navigate this. This takes a little bit of time. And really the easiest way to get a snapshot of what a fund is about is go, blah, blah, blah. That all looks like double Dutch to me. Let's ignore all that. And let's look at, okay, they always have to give you the top 10 holdings. And here we go, top 10 holdings. Microsoft, L'Oreal, Estee Lauder, IDEX, actually, I'm not entirely sure what that one is. PayPal, Meta is Facebook. So you start to see, a lot of those names. You get an idea of the sort of companies that he invests in. So at a glance, you can see his style. And he tells you, I'm no nonsense, no fee, no upfront fees, no leverage. He doesn't use anything to sort of turbocharge, no nonsense, no shorting, no trading, no hedging. And he will also give you the size of the fund, and that's important. This one's quite big, 26 billion. Anything below 500 million, I would say you're looking at less liquidity, not so many people own it and trade it. So as a rule of thumb, I wouldn't go too small. I think $1 billion is a good size fund. And then here are the fees. He's charging you 1.17%. Which is a lot more than 0.2 for a tracker fund. And then you go, okay, so what's his performance? This takes a little bit more detective work. So you get your Sherlock Holmes hat on and you have to kind of scout around, but basically performance will be there. And here it is. And always in very small print, which is quite annoying. It says, okay, this is what Fundsmith had done. Okay, he had a bad January. Stock market's down about 5-6%. He's done worse than that. But since inception, or since he launched, he is up 500% and all the stock market is up 270. And he tells you which benchmark he's using, little asterisk 2. And we go in there and say, yes, I know what that is, MSCI World Index. So he uses the MSCI World Index. So compared to that World Index, which covers 3,000 companies, he has consistently beaten that index really every year except for 2018 and the start of this year. So you start to say, okay, well, is it worth it? Is it worth paying 1%? And that's, again, where active management does come in. And you can go right down to quite specialist funds, as I mentioned, green energy or biotech, and even some crypto traded funds are being launched again. As I said, not recommend anything, but just saying you can really express your interests and areas that you think will do well through buying either tracker funds and or actively managed funds. But I think it's worth being cognizant of the fact that if you just want a simple life and you only want to look at this once or twice a year, then the simple solution is to work out how much risk you want, work out whether you're 1 to 7 on the scale, how much equity you want, and buy a global tracker fund. And then you only have to look at it once in a while. So in a nutshell, and this is perhaps the most, what it comes down to is, and this is the recap slide, is what to look for. Well, you know that you can generate a 6.7% return, or the stock market has generated that the last 100 years, but there's risk. So you could lose capital. And certainly if you need it in a shorter time frame, there's a high risk. So be comfortable with that risk, know the time frame that you need money for. And what risk really is things going up and down, volatility. And the stats are, on average, every 10 years, you have 3 down years. They're not always consecutive. You don't know when they're going to happen. And yes, we're due one. But I might be wrong. It might take 2 more years to happen. So again, Mystic Meg is the only one who really knows the answer to this. Timing the market is very difficult. Some people say to me, well, why wouldn't I wait now and try and time it? Fortunes have been lost trying to do that. And markets move very quickly. And it's also been shown that if you miss 3 of the biggest move days in a year, very often you'll miss some of the returns. You know, we have had days where things can move 3-4%. And if you're not in it that day and you're trying to buy it that day, then say the market does a 10% return over the year, you've missed 1/3 of it. So it's time in the market that is the answer. And you'll hear that from all professionals, unless they're traders. And that's fine. There's a role for traders, but long-term fund management is not trading. And in fact, there's been some research done, and I just chuck it in. Female fund managers are very good. Fidelity did some research and found that they generated a slightly higher return over the cohort that they studied of 0.5% a year. But the answer was women do tend to do a bit more. They tend to be do a bit more research, trade far less, which is the key, and hold for the longer term. Frankly, I don't think there's much difference between male and female fund managers, but just interesting that the performance, if you over trading can hurt performance, and that was really what the study showed. So the other things to look out for: do you want to keep your life simple, just with and low cost with a tracker fund? Do you want some actively managed funds which could give you better returns, give you to different sectors, but you have to manage that a bit more carefully and be across it, talk it through with your financial advisor or wealth manager, and then you do need to check it. And then the last bit is financial advisors and wealth managers, like all of us, can get a bit lazy. So you need to hold them to account. And this is the other important piece. And do know at the end of the year what stock market has done, the global index. You have the tools. The Morgan Stanley fact sheet is available monthly. You can go to ARC to see what a blended balanced portfolio average return is. And if you're consistently underperforming, then you need to ask the question why of your financial advisor. So that gives you the tools to engage with them. And the good news is, what I have found for those that have done my course, mainly women, as I said, they have found that when they did go back to their financial advisor, the financial advisor just went, oh, look, now I can talk to you, understand this. This is great. Well, look, we can look at this, and this is what I'm thinking, and these are my thoughts, and how about this? And actually, it was a much more positive experience. It isn't that they were being patronizing or trying to, it's just that the language wasn't there to communicate. So I think just those building blocks enable a much better dialogue and engagement with our finances, which is what this is all about.
Thank you, Sarah. I couldn't agree more. I have had financial advice over the last X number of years. I found it mesmerising, but now I know a lot more about it. I can understand just simply the terminology. I can actually understand what they're saying, which is just so important and so empowering. So thank you so much. That was absolutely fantastic. And I should be looking at the ARC later to see how we're doing. Fascinating. So does anyone have any questions? I know, Elspeth, you did. And I think probably at this point, rather than putting them in the chat, we may as well get people to unmute themselves and they can ask it directly. So please just go ahead.
I had another question, actually, if you don't mind.
Yes.
One of them was, you mentioned that you run courses. I haven't looked into any of this, but what are your courses? How are they made up, and when do you run them, and that sort of thing?
I run courses for 2 to 3 typically. That's the ideal number. And I ask people to commit to the 4 modules of 2 hours each, because over 8 hours, really, we look at what we've looked at today, but in more detail. And that enables most of us to then go out there and engage with the knowledge and the confidence required. I'm happy to do smaller groups for shorter periods if they're bespoke, but I do find the best results is really about 6 to 8 hours. And then everyone's good to go.
Yeah, okay.
I'll put all the details in the post-events comms, but actually I think that's something I might be interested in. So Elspeth, maybe you and I could do that together.
Yeah, definitely.
Right, so Elspeth, did you have the questions that you posed at the beginning?
Yes, well, I suppose I was interested to find out, so for example, if a grandparent was going to give a lump sum to a grandchild or a number of grandchildren, I mean, so in our particular case, our grandfathers, or my children's grandfather is early 80s. I guess it depends how much the grandparent was going to give, but what would your advice in terms of what the children should perhaps do with that money, assuming that they might like to invest in property in the next 5 to 10 years? What should they do with it? And also that there's a potential for inheritance tax to be paid if that grandparent died within 7 years of the gift.
Yes, yeah. Look, I have to say, I'm not a financial advisor and I'm not a tax advisor, so I really can't answer that specific question.
No,
but what I can say is that junior ISA, you can put in 9,000 a year, which is a fair bit of money.
Yeah.
And that's quite a good way of getting the younger generation engaged. They do have access to it at 18. So some people say that's too risky. I mostly, from what I've read, actually the young handle it very well. And that can certainly provide, if you, okay, time may not be on your side, but certainly if you think, you know, 9,000 over 10 years, tax-free, and that has no, as far as I'm aware, that can go in. There was an article in the FT about it. I can't really comment on it, but I think you can. There's extra money that can go in, but it's via trusts and it can be structured. You'd have to get advice on that. I think certainly from the engagement side, from the younger generation, I think involving them in how it's invested is really positive. And it can contribute towards deposit on a house as well as student fees.
Yeah. Okay. Thank you.
Does anyone else have a question they'd like to ask? No?
Well, I do have a question, but it's not perfectly formed, so you'll have to forgive me as I try to rumble through it. I'm curious to know if you have a view on the domestic bricks and mortar market and as a sort of overall split of one's capital. You know, if one has 2/3 in bricks and mortar, as in actual, you know, household, versus say 1/3 in a blended portfolio. Do you have a sort of macro view, given, you know, the prospect of stagflation, et cetera, do you have a view as to that overall mass capital diversity?
Yeah, it's a really good question, that one. I think, can we take the principal residence, the home, out of it and go, that is an asset that we need to live in. So we have to take that out of the wealth equation. If you then got investment property, then I think you can put it into the investment and savings ledger and look at that. Because we need to live somewhere. So I would take the home out. And then it does come down to choice. If we were in more normal market circumstances, I think that chart I showed you with the Morgan Stanley Composite Index return being very similar to property, peak London property, and in fact a little bit better than UK property overall. And that holds true of property pretty much throughout history and globally, that chart. So in that sense, I would still say you would favour other asset classes, including investment property. But of course, stagflation is a very different matter. And in the 70s, as far as I'm aware, initially property did fall, but then it recouped very quickly because it's a real asset and it's something you can enjoy. And if things go really pear-shaped, at least you own bricks and mortar. So I think there's a lot to be said for bricks and mortar. Certainly if we do enter this 2-year period where there is risk of higher inflation and lower growth, however, I would caveat that by saying that what then happens is the government goes, if inflation goes up too fast and wages are going up similar amounts, then the government puts up interest rates to cool the economy. And we all know what happens to property when interest rates go too high. Property falls. So simply saying property is a hedge for inflation is probably true longer term, but again, you can have periods where, you know, in London it caused a 20% fall briefly in I think it was in the mid 80s. Interest rates suddenly shot up and the property market really did take a bit of a hit. It came through again quickly. So, but going back to your comment, what we are also seeing, we didn't touch much upon alternative assets, which includes hedge funds, which we won't go into because I think we can leave those. But something that is included in alternative assets other than commodities is also real estate investment trusts, REIT as they're called. And those are commercial property, and also, for instance, warehouses for logistics for delivery points. And those are a couple of areas that people are investing in as a hedge for inflation. So what people are looking at when they're investing now is finding companies or businesses where their pricing power is good, so they can up their prices in line with inflation. And it's that pricing power element that I think is important. And in that sense, rents could indeed, from investment properties, could provide some hedge.
Good. Thank you very much.
Excellent. Any other questions? No.
Yeah, I'm sorry. What are your views on kind of emerging markets, kind of like Africa and South America, and investing in those?
Investing in those. Well, yes, it's interesting. I mean, I worked 5 years on South American markets, and I love South America, and I wish it was doing better because I think it's the most amazing place. So my heart is saying, put your money there. My head is saying, watch out. The difficulty with these markets is they're growing well. GDP is growing, and there's a whole new young generation coming through. There has been a lot of political risk. Certainly Argentina is probably going to default again. Brazil has quite a few corruption issues. So they're difficult markets to follow. Certainly we saw that in the period 87 to date, they've done pretty well, but the last 10 years they have not done well. Actually, a few much cleverer portfolio managers than I am are beginning to dip a toe back into emerging markets because they're going, they've underperformed for some time. They are quite cheap, and we think they are worth investing for the longer term. So they may well be right, but I think you have to go in eyes wide open. The same is true of what we call the frontier markets, which would be Africa. It's got the massive potential, but they're called frontier markets because they are still very high risk. Vietnam was included in there. So you can buy funds that specialize in these frontier markets. And I would say, as with all these things, just put a small amount in and get familiar with it, get used to how it trades, what happens, and then you can become more comfortable with your investments there. But I wouldn't, again, put all my eggs into one basket.
Sounds like very sound advice indeed. I think we'll leave it there. Thank you so much, and I'll hand back to Sarah.
Sarah, thank you very much indeed. And really comprehensive, really informative, and very engaging. We hope very much you've enjoyed this, and for anyone catching up on this later on, I hope that's answered many of your questions and that you found it very useful. As we mentioned at the beginning, we're going to be sending you a recording afterwards, so please do enjoy it and enjoy it at your leisure. Caroline will send you the recording, but she'll also send you Sarah's contact information and also information about the courses, which I think was something of interest as well, and we would highly recommend. So we hope very much you've enjoyed this morning. We invite you to join the Really Helpful Club and hope you will enjoy being part of our vibrant and fast-growing community. And we're here to help you to take your next step forward. So thank you very much for your time today.